markets teams globally, was the #1 broker for hotels in Europe last year. And many of you may know the JLL hotels team here, run by Nihat in Singapore, covering Asia Pacific. So I'll just run through a few macro issues to begin with about the UK economy. Never a dull day in the UK. Horses running free through the streets of London. Always something interesting happening. And of course, this year we've a point in time they decide to call it. We all have the election, which of course at this point, if you look at all the polls, points towards a change of government, but never trust the polls too closely in the UK because they have been proved incorrect in the past. But either way, as many of you will know, of course, the UK has been through a particularly interesting time since the Brexit vote back in 2016 and the eventual leaving from the European Union, and then of course COVID, the recovery from COVID, and so on and so forth. So forecasts according to Oxford Economics that we use across the world show hopefully 3 or 4 years of continued growth for the UK economy moving forward. And as we know, although the UK numbers may not look particularly impressive, London always outperforms the rest of the UK. And in fact, since the recovery from COVID has seen an outsized amount of capital being invested in the commercial property markets over and above in Paris and Germany and Spain and Italy and so forth. And so, of course, the #1 issue, not just for the UK, but of course for all of us around the world, is when are these inflation numbers going to get back under control? We've seen a slight kind of uptick in a lot of the advanced economies. Australia yesterday announced a little slight uptick. I don't think, the last 20% of getting inflation down is always the hardest. If you look back in history, you get the big drop and then that last bit to get it back under target. So I think it certainly looks like, although in the US they may delay the interest rate cuts, I don't think in UK and Europe they can afford to delay the cuts. I think we'll start to see those come through probably sometime maybe early summer, if not late summer, for those effects to start to feed in, because they certainly probably don't want to, particularly in the UK, leave it too close to the election, because then they get accused of interfering with the electoral process, which is the last thing the Bank of England need. They've got enough things to be concentrating on. So, I just wanted to touch quickly on currency. We have a big currency unit in JLL these days. We do a lot advising our clients on hedging strategies, both with interest rates and with currencies around the world, because the movement of capital within commercial real estate has got bigger and bigger, even though transactional volumes has declined slightly over the last couple of years. So you'll see investors from Singapore going into the UK. This is on a 5-year basis with no 5-year investment hold with no leverage. Obviously, you can juice your returns by using leverage either here or in the UK, whatever works best for you. But it's been a slight drag, or it will be a slight drag on the performance side. Not as bad as Japan, but everywhere the Japanese go, they have problems with their investments, which is why so many of them hold USDs. And you can see over time, and it's really since the interest rate rises have started in the UK, has made it slightly more different on the currency side. But if you look over time and actually where we are at the moment in comparison the Sing dollar against the pound, we're pretty close to almost record highs of exchange rates. So what they take away from you in the interest rate issues, they give back to you on the currency exchange rate, hopefully. So kind of equals itself out. And again, in most of these investments, it's always the property that is the key determinant. These help to juice your returns potentially, but it's always the quality of the property and the managers that will determine essentially how well things pan out for you. So just looking at how the recovery in the UK has played out really since COVID. Like all hotel markets, you know, the UK and London came to a complete standstill during COVID, but the acceleration and the number of international visitors, I think, has surprised everybody. People's willingness to travel, people's desire to travel after the pandemic has certainly, I think, exceeded everybody's expectations, and hotel markets and hotel performance has been the strongest of all of the commercial property markets globally since the world started to get back to normal in 2021 and 2022, and that has accelerated, and we've seen some, not least here in Singapore, some unbelievable hotel rates that have been achieved, particularly when we have the big events like F1 or Taylor Swift in town, and Taylor Swift will be in the UK this summer actually, so we'll see how London and the other big cities' hotel rates do. So you can see the bounce back in performance, I think, has been much, much stronger than we were anticipating. I think if COVID hadn't happened, I don't think, you know, performance probably on an ADR and a RevPAR basis and occupancy probably would have been fairly consistent and not grown as much as we've seen in this, particularly 22 and 23, and that is also will play into the 2024 performance as well. So quite an interesting dynamic, and as I said, we're not seeing this in many other of the other commercial property sectors in the UK. We're seeing some rental growth in offices, but a lot of the other segments are really lagging where we're seeing hotel performance. And because of all the issues that were stored up from COVID, and you know, not just in the UK but around the world in terms of construction activity, construction costs, although the supply of rooms is increasing, you can see the pipeline is diminishing. So it's getting harder and harder to add new hotel rooms across the whole of the UK, even at a time when performance is increasing particularly well at the moment. And so you can see very clearly when interest rates went up for the UK commercial property market, and that has had an impact obviously on people's willingness to transact. And we saw the drop off in 22 and a further drop off in 23. I think globally in the first quarter we saw a bit of a bounce back. Obviously expectations are that interest rates will start to come down, so people's attention starts to move towards other investment classes, and we expect, given the pipeline of product that we're starting to see come onto the market in the UK and Europe, that hotel transactions will accelerate quite rapidly as we go through the second half of the year. Interestingly, mostly single asset transactions, not many big portfolios, which kind of marked the period before COVID. We saw quite a number of very big, you know, billion pound portfolio transactions. These days it's more single asset transactions that tend to come onto the market. And so, as I mentioned, in terms of the economic performance, you know, London and the Southeast is the big driver of UK economic performance and tends to outperform the rest of the market. So you can see the growth that we've seen in ADR and RevPAR has been stronger in London than when we looked at the UK overall, and you can see all of the indicators are showing growth over the year previously. So it's been a very strong 2023 and first quarter or so of 2024, and certainly nothing at the moment that is causing us any concerns in terms of a potential slowdown. I think if you look at the forward purchases of flights into the UK, and I saw something from Heathrow Airport asking for extra capacity, asking for the number of flights to be increased. Quite difficult to do in Heathrow because it's already chock-a-block and very difficult to squeeze any more flights in without the additional runway, which who knows if it will ever